I want you to begin with a simple object that most people think they understand. A $100 bill. If I hold it in my hand and ask what it is worth, most people will answer without thinking. They will say it is worth $100. That answer is technically correct, but it hides the real question: what can $100 actually buy? That is the question that matters. $100 today is not the same economic object it was 5 years ago. It is not even close to what it was 50 years ago. The number printed on the paper has not changed. The design may have changed a little. The promise printed on it may still look official. But the purchasing power inside it has changed dramatically. That distinction is the key to understanding what is happening to the dollar, to oil, to gold, and to the global financial system. Most people look at money as a thing. I look at money as a claim. It is a claim on goods, services, labor, energy, food, shelter, and security. If the claim becomes weaker, it does not matter that the number printed on the bill remains the same. You are still poorer in real terms. That is why the news about the United Arab Emirates leaving OPEC matters much more than most people understand. Many people will look at it as a Middle East story. They will think it is about oil quotas, production disputes, and politics inside OPEC. Those things are part of it. But the deeper story is about the dollar. It is about the system that has helped support the dollar for roughly half a century. It is about what happens when the system that gave the dollar constant global demand begins to develop cracks. To understand the present, you have to go back. Before 1971, the United States dollar had a different foundation. It was connected to gold. That did not mean the system was perfect. No monetary system is perfect, but the logic was clear. If the government wanted to create more claims, it had to pay attention to the amount of gold behind those claims. Gold acted like a constraint. A constraint is important in any system. Without constraint, behavior changes. On the 15th of August, 1971, President Richard Nixon suspended the convertibility of the dollar into gold. He called it temporary. More than 50 years later, we are still living inside that temporary decision. That was a major transition. The dollar moved from being tied to gold to being a fiat currency. Fiat currency is not backed by a physical asset. It is backed by trust, law, habit, institutions, and the belief that other people will accept it tomorrow. People often underestimate how powerful belief can be. A currency works because enough people agree to use it. It fails when enough people start doubting it. That is true in households, companies, countries, and empires. Money is a social contract with numbers printed on it. Once the dollar was no longer backed by gold, the United States needed something else to support global demand for it. That something became oil. A few years after the break from gold in 1974, the United States made an arrangement with Saudi Arabia. The basic logic was simple. Saudi Arabia would sell oil in dollars and recycle its oil profits into dollar assets, especially United States treasuries. In return, the United States would provide military protection, weapons, and political support. That was the beginning of what most people call the petrodollar system. This was not just a diplomatic deal. It was a monetary machine. Every country needs energy. Every country needs oil. If oil is priced in dollars, then countries that need oil also need dollars. They have to earn dollars, buy dollars, borrow dollars, or hold dollars in reserve. That creates constant structural demand for the United States currency. That demand gives America an enormous advantage. It allows the United States to borrow more cheaply than it otherwise could. It allows the United States to run larger deficits than most countries could run. It allows the American consumer to import goods from the rest of the world with a currency the rest of the world still wants to hold. It supports the Treasury market, it supports Wall Street, it supports the American standard of living in ways most people never see directly. This is what I mean when I say you must look beneath the surface. The price of a dollar is not just set by a central bank, it is set by a network: oil pricing, Treasury demand, military power, trust, trade flows, and reserve holdings all connect together. When the connections are strong, the system looks stable. When the connections weaken, the system can still look stable for a while, but the internal pressure is changing. That is why the UAE leaving OPEC is not just another headline. OPEC has been a central institution in global oil politics for decades. The countries inside that system have historically operated, for the most part, within a dollar-centered oil framework. When a major oil producer that has also been vocal about reducing dependence on the dollar decides it wants to move on its own terms, that tells you something about the changing incentives inside the system. The UAE wants more independence, it wants more flexibility. It has worked with countries such as India on trade that does not always require the dollar. It has shown interest in doing business outside the old arrangements. It has become part of a broader group of countries asking whether the dollar should remain the only highway through which global trade must move. That does not mean the dollar collapses tomorrow. I want to be very clear about that. Systems of this size do not usually fall in one day. They erode, they fragment, they become less dominant before they become obviously weaker. They lose monopoly power before most people notice that the monopoly has been lost. In my life, I have learned that reserve currencies do not lose their role because one event happens. They lose their role when many small incentives begin to point in the same direction. That is what you have to watch. The first major pressure came from the way the United States responded after the pandemic. The government spent enormous amounts of money it did not have. Stimulus checks went out, unemployment support went out, PPP loans went out, businesses were supported, financial markets were stabilized. Some of that was necessary to prevent an immediate collapse, but it also revealed something uncomfortable. A government that controls a fiat currency can create more currency very quickly. It can print more dollars, but it cannot print more real wealth. That is the difference many people miss. You can create claims, you cannot create goods, services, productivity, energy, and trust out of nothing. When too many claims are created against the same underlying wealth, the claims become worth less. That is inflation in its deeper form. Other countries saw this. They watched the United States create trillions of dollars. They watched asset prices rise. They watched the purchasing power of money decline. They asked a rational question. If the United States can create this many dollars in a crisis, should we keep storing so much of our national wealth in dollars? That question did not destroy the dollar, but it changed the psychology. Then the Russia and Ukraine conflict accelerated the process. After Russia attacked Ukraine, the United States and its allies froze and seized Russian assets held within the Western financial system. From one point of view, this was a geopolitical response to aggression. From another point of view, every other country learned a lesson. If your reserves are held in someone else's financial system, they are not fully under your control. That realization matters. It does not only matter to Russia, it matters to China, it matters to Saudi Arabia, it matters to the UAE, it matters to India, it matters to every country that could one day find itself in conflict with the United States or on the wrong side of American policy. When a reserve asset can be frozen, it is no longer risk-free in the eyes of the holder. That is not a political statement. It is a risk management statement. Large institutions think in terms of probability and consequence. Central banks do the same. If there is even a small probability that your dollar assets could be frozen in the future, and the consequence would be severe, then the rational response is to diversify. You do not have to hate the dollar to diversify away from it. You simply have to understand counterparty risk. That is why gold became so important again. Gold has no nationality. It has no board of directors. It has no central bank. It cannot be printed by a government, defaulted on by a company, or frozen by a bank account custodian. If it is held directly, it does not produce cash flow, so it is not the same kind of asset as a productive business, but it is a reserve asset that sits outside the promises of the fiat system. That is why central banks have been buying it. They are not buying gold because they suddenly became emotional gold bugs. They are buying gold because the world is becoming more fragmented, and in a fragmented world, assets without counterparty risk become more attractive. This is where the numbers tell the story. In 2001, around 72% of global currency reserves were held in United States dollars. By the end of 2025, that share was closer to 56%. The dollar is still the dominant reserve currency, but the direction matters. A system can still be dominant and weakening at the same time. Most people do not understand this because they think in binaries. They ask, is the dollar strong or weak? Will it collapse or not collapse? Is the United States finished or not finished? That is not how the real world works. The better question is, what is the direction of change? What incentives are pushing the system? What are the major players doing with their reserves, their trade contracts, their energy flows, and their long-term plans? If you look at those things, the pattern becomes clearer. China has been trying to strengthen its own role in global trade. It does not want the entire world to depend on the dollar. It has created oil futures priced in its own currency. It has worked to buy oil from major producers in yuan, Saudi Arabia. The country that helped build the Petrodollar arrangement has already shown a willingness to sell some oil to China in yuan. India has used local currency arrangements. The UAE has also worked on transactions outside the dollar. These are not isolated events. They are signs of a gradual redesign of the monetary plumbing. Again, I am not saying the dollar disappears. The United States is still the largest and most important economy in many ways. It still has the deepest capital markets. The treasury market is still central to global finance. The American stock market still attracts capital from the world. The dollar is still used across trade, debt, savings, and settlement. But the old assumption that the dollar's dominance is automatic and permanent is becoming more dangerous. No dominance is permanent if the incentives supporting it weaken. That is the principle. For decades, the dollar benefited from the petrodollar system. Oil was priced in dollars. Oil profits came back into treasuries. The United States provided security. The system created a loop. Countries needed dollars to buy oil. Oil producers accumulated dollars. Those dollars funded American borrowing. American borrowing supported American power. American power helped defend the system. That loop is still alive. But it is no longer unquestioned. When countries begin settling oil in other currencies, even partially, the loop weakens. When central banks buy gold instead of only accumulating dollar reserves, the loop weakens. When major producers leave old institutions and seek more independent paths, the loop weakens. When geopolitical rivals build alternative payment systems, the loop weakens. Each individual crack may look small together. They show a shift in the environment. This is why I pay attention to systems, not just events. A single event can be noise. A pattern of events can be a signal. The UAE leaving OPEC may or may not change global oil trade immediately, but it is part of a broader pattern in which oil producers, emerging powers, and central banks are reducing their dependence on one currency, one payment system, and one geopolitical center. That matters to ordinary people because ordinary people earn, save, borrow, and invest in dollars. If the dollar loses purchasing power, your savings feel it. If global demand for treasuries weakens, interest rates can feel it. If energy trade moves in different directions, inflation can feel it. If gold rises. Because institutions are hedging the dollar, portfolios can feel it. If foreign economies benefit from stronger local currency systems, international markets can feel it. This is not abstract. The value of your paycheck depends on the value of the currency it is paid in. The value of your savings depends on the purchasing power of the dollars sitting in your account. The value of your retirement account depends partly on how assets respond to inflation, rates, currency weakness, and global capital flows. Most people only notice these things after they become painful. A good investor tries to see the cause before the effect becomes obvious. So the question becomes, how should a rational person think about this environment? I cannot tell you what to buy. I am not your financial advisor. I am not giving you personal financial advice. What I can do is explain the framework. When a reserve currency is under pressure, the first asset people usually talk about is gold. That is understandable. Gold tends to perform well when people lose confidence in paper currency, when central banks are buying, when geopolitical risk rises, and when governments are printing more claims than the real economy can support. But you must understand what gold is and what it is not. Gold is not a business. It does not grow earnings. It does not pay dividends. It does not innovate. It does not hire employees. It sits there. Its value comes from scarcity, history, trust, and its role as a hedge against the weakness of fiat money that makes it useful in some environments and less useful in others. After the 2008 crisis, gold rose strongly because governments and central banks were creating money to stabilize the system. People were worried about the dollar, the banking system, and the long-term value of paper assets. Then, when those fears faded and it became clear that the system was not collapsing, gold fell and struggled for years. That is an important lesson. Gold does not always go up. It responds to conditions. When concern about the dollar rises, gold often benefits. When concern falls, gold can weaken. That is why I would not think of gold as a magical investment. I would think of it as a hedge, as hard money, as a way to hold some value outside the dollar system if that fits your overall strategy. Some people hold physical gold. Some use gold ETFs such as GLD to get exposure without storing metal. Each method has trade-offs. Physical gold removes some counterparty risk, but creates storage and security problems. ETFs are easier, but they bring you back into the financial system. There is no perfect answer. There are only trade-offs. That is true of all investing. The second way to think about this environment is international diversification. If the world is slowly moving away from a dollar-centered system, then it may make sense to understand what exists outside the United States. That does not mean abandoning the American market. It means recognizing that other economies may grow, other currencies may strengthen, and other markets may benefit if capital becomes less concentrated in the United States. There are broad international funds that provide exposure to many countries. There are developed market funds that focus on larger, more established economies outside the United States. There are emerging market funds that focus on smaller, faster-growing, and often riskier countries. There are country-specific funds for places such as China, India, Germany, and others. But international investing has risks. Currency risk matters, political risk matters, market structure matters, regulation matters, corporate governance matters. The fact that a country is outside the United States does not automatically make it better. Diversification should not be a slogan. It should be a considered decision based on how different assets behave under different scenarios. The third area to think about is energy. If the petrodollar system is under pressure, then oil and energy remain central. The world still runs on energy. Geopolitical conflict still affects supply. If countries become more concerned about depending on foreign energy, domestic energy investment may become more important. If oil trade becomes more fragmented, energy companies may become strategically important. Again, in the United States, one way investors think about energy exposure is through energy funds that hold companies such as Exxon, Chevron, and ConocoPhillips. These are not just companies. They are part of the system that produces and distributes the energy modern economies still require. But energy is cyclical. Oil prices move. Political pressures change. Technology changes. Energy investing can be profitable, but it can also be volatile. You need to understand what you own and why you own it. The fourth area is defense. I know this makes some people uncomfortable. It should make people uncomfortable. War is not something to celebrate, but if you are trying to understand capital flows, you have to look at reality as it is, not as you wish it to be. When geopolitical tensions rise, governments spend more on defense. When countries feel less secure, military budgets grow. When the world becomes more fragmented, defense contractors often receive more orders. Funds that hold aerospace and defense companies can benefit from that trend. That does not mean every person should own them. Investing has to make sense financially, legally, and morally. You have to use your own compass. But you should at least understand how Wall Street thinks. Wall Street looks at government budgets, contracts, geopolitical tensions, and long-term demand. It does not look away just because the subject is uncomfortable. The fifth area is still the United States itself. This is very important. A weakening dollar monopoly does not mean the American economy disappears. The United States still has extraordinary strengths. It has deep capital markets, innovation, strong companies, productive assets, major technology platforms, and the world's most important stock market. Even if the dollar's share of reserves falls, the American economy can still create enormous wealth. That is why a broad United States stock market allocation or S&P 500 exposure remains part of the conversation. The mistake would be thinking in extremes. Some people hear about de-dollarization and assume everything American must collapse. Other people hear that the dollar is still dominant and assume nothing can change. Both are too simple. A more accurate view is this: the dollar is still powerful. The dollar is also facing structural pressure. The United States is still a remarkable economy. The United States is also carrying debt, inflation, and reserve currency risk. Gold can hedge dollar weakness. Gold can also fall when fear fades. International markets can diversify risk. International markets can also introduce new risks. Energy and defense can benefit from geopolitical change. They can also be volatile and politically sensitive. That is how real investing works. You do not get certainty, you get probabilities. When I look at the petrodollar system, I see a machine that has worked for 50 years because the incentives lined up. The United States needed oil stability and global dollar demand. Saudi Arabia needed security and a place to recycle oil profits. Oil buyers needed access to energy. Treasury markets needed buyers. Everyone had a reason to participate. Now the incentives are changing. Oil producers want more freedom. China wants more influence. Emerging markets want more independence. Central banks want less exposure to frozen reserves. Governments want assets that cannot be sanctioned. Investors want protection from inflation. The United States still wants the old system to remain strong, but it is carrying more debt and printing more claims than it used to. That is the tension. The old system is not gone. The new system is not fully formed. We are in the transition. Transitions are where many people make mistakes. They either assume nothing is changing and stay exposed to the old structure, or they assume everything is changing overnight and make extreme moves. Both can be costly. A better approach is to understand the direction and adjust gradually. That means paying attention to what central banks are doing, not just what politicians are saying. It means watching global reserve shares. It means watching oil settlement agreements. It means watching whether countries price trade in dollars or in local currencies. It means watching whether treasury demand stays strong. It means watching whether gold continues to attract institutional buying. It means watching whether energy producers and defense companies are receiving capital because of the new geopolitical environment. Most people do not watch these things. They watch headlines. Headlines tell you what happened. Systems tell you why it happened. The UAE leaving OPEC is a headline. The system behind it is the gradual weakening of the dollar's oil monopoly. Saudi Arabia selling some oil to China in yuan is a headline. The system behind it is China's attempt to build an alternative trade architecture. Russia's reserves being frozen is a headline. The system behind it is every other central bank reassessing counterparty risk. Gold rising is a headline. The system behind it is central banks and investors responding to debt, inflation, sanctions risk, and currency debasement. The dollar's reserve share falling from 72% to around 56% is a statistic. The system behind it is diversification away from one dominant currency. When you connect these pieces, you see the broader picture, and once you see the broader picture, you stop reacting emotionally. You do not panic. You do not assume the dollar is dead tomorrow. You do not assume gold can only go up. You do not assume international markets are automatically better. You do not assume America has no future. You simply recognize that the world is changing, and you build a portfolio that can survive more than one outcome. That is the essence of good decision-making. A portfolio should not depend on one story being perfectly right. It should be resilient across different possible futures. If the dollar remains strong, productive American assets can still do well. If the dollar weakens, gold and hard assets may help. If global capital shifts, international exposure may matter. If energy security becomes a priority, energy companies may benefit. If geopolitical tensions rise, defense spending may remain strong. If the United States keeps innovating, the S&P 500 may continue to create wealth over time. The point is not to bet everything on one outcome. The point is to understand the changing probabilities. That is what most people fail to do. They work for dollars, they save in dollars, they measure wealth in dollars. Then they ignore the forces that determine what those dollars are worth. They assume the system behind their money will always be there because it has always been there in their lifetime. But history teaches the opposite. Monetary systems change, reserve currencies change, trade routes change, energy systems change, empires rise, peak, become overextended, and then adjust. Sometimes the adjustment is orderly, sometimes it is painful, but the pattern is never that the world stands still. The petrodollar system gave the United States extraordinary advantages. Those advantages helped shape the modern economy, but the same system created habits. It allowed more borrowing. It made deficits easier. It made the dollar look more permanent than any human system really is. Now the world is testing that permanence. The UAE leaving OPEC is part of that test. China's push to price oil in yuan is part of that test. Saudi Arabia's willingness to work with China is part of that test. India's local currency oil transactions are part of that test. Central bank gold buying is part of that test. The decline in dollar reserve share is part of that test. None of these alone ends the dollar together. They show you the direction. The dollar still matters. It may matter for a long time. But if you are an investor, you should not simply ask what is true today. You should ask what is becoming less true over time. For 50 years, it was mostly true that oil meant dollars. Now it is becoming less true for decades. It was mostly true that central banks trusted dollar reserves as the cleanest place to store national wealth. Now it is becoming less true. For a long time, it was mostly true that the United States could print, borrow, and spend without other countries seriously challenging the dollar system. Now it is becoming less true. Those are not predictions, they are observations. A thoughtful person should not ignore them. What I would do is think in principles. The first principle is that purchasing power matters more than nominal dollars. If your account balance stays the same while the currency weakens, you are losing wealth. The second principle is that reserve currency status is a privilege, not a birthright. It must be earned through trust, discipline, productivity, and global demand. The third principle is that when governments print too much relative to real wealth, hard assets become more attractive. The fourth principle is that when geopolitical risk rises, countries reduce counterparty exposure. The fifth principle is that diversification is not about predicting the future perfectly. It is about not being ruined when the future is different from what you expected. Those principles explain the current moment better than any single headline. The dollar's role is changing because the world that supported it is changing. The old oil dollar treasury loop is no longer as clean as it once was. Countries are experimenting. Central banks are hedging. Investors are waking up to the fact that money is not just numbers on a screen. It is a system of trust, power, incentives, and claims. When that system changes, your strategy has to change with it, not through panic, through understanding. The worst thing you can do is ignore the transition until it shows up in your grocery bill, your mortgage rate, your retirement account, or your savings purchasing power. The second worst thing you can do is overreact and assume one asset solves every problem. There is no single perfect answer. Gold has a role, but it is not everything. International investing has a role, but it is not everything. Energy has a role, but it is cyclical. Defense has a role, but it must fit your values. The American market has a role, but it should not be treated as immune to monetary consequences. A strong portfolio is built by understanding the system and then choosing exposures that make sense under different scenarios. That is what serious investors do. They do not just ask, what is the next hot stock? They ask, what is the machine? What is changing in the machine? Who benefits if the change continues? Who gets hurt? What risks am I taking? What risks am I reducing? What happens if I am wrong? What happens if I am right? What happens if I am early? What happens if I am late? Those questions matter more than excitement. The petrodollar system is not a small subject. It is one of the major pillars under the modern financial order. When that pillar weakens, the effects spread. They spread into currency markets, they spread into inflation, they spread into bonds, they spread into gold, they spread into oil, they spread into international equities, they spread into the price of everything ordinary people buy. That is why I would not dismiss this story. At the same time, I would not exaggerate it into doomsday. The correct view is disciplined realism. The dollar is still dominant. The dollar's dominance is being challenged. The United States is still powerful. The United States is less financially disciplined than it used to be. Gold is not magic. Gold is becoming more relevant. Oil is still traded largely in dollars. More countries are testing alternatives. The system is not ending in one moment. It is gradually being renegotiated. Most people will not understand this until much later. They will hear about it after the big moves have already happened. They will hear that gold has risen, that reserves have shifted, that trade deals have changed, that currencies have moved, that inflation has eroded their savings. Then they will ask why nobody told them. But the signals are already here. They are in the reserve data. They are in central bank gold purchases. They are in oil settlement agreements. They are in the UAE's move away from OPEC. They are in China's strategy. They are in Saudi Arabia's willingness to transact differently. They are in the way countries responded after Russia's assets were frozen. They are in the way the United States has used debt and money creation since the pandemic. You do not need to know the exact future to see the pattern. You need to know enough to avoid being passive. That is the message. If you earn in dollars, save in dollars, invest in dollar assets, and plan your future around dollar purchasing power, then you must understand the forces affecting the dollar. You do not have to become a currency trader. You do not have to become a gold fanatic. You do not have to abandon the American market. But you do have to stop assuming that the background system will always protect you, because systems protect themselves first. When debt rises, governments choose the path that preserves the system. When currencies weaken, savers pay part of the cost. When geopolitical trust breaks, reserves move. When oil producers change their settlement behavior, the currency system feels it. When central banks buy gold, they are telling you something without needing to say it directly. The dollar has value because people trust it. Trust can persist for a long time. It can also decline slowly. Then suddenly the purpose of studying this is not fear, it is preparation. I have spent my life studying cycles, debt cycles, monetary cycles, political cycles, human behavior cycles. The same patterns come back because human nature does not change very much. People borrow too much in good times. Governments spend too much when money feels easy. Investors assume recent stability is permanent. Then the system shifts, and the people who did not prepare are surprised. You do not want to be surprised. You want to be thoughtful before the crowd is forced to be thoughtful. That means looking at the $100 bill and seeing more than the number. It means asking what that bill can buy now, what it could buy in the past, and what it might buy in the future if the system behind it keeps changing. It means understanding that the dollar was once backed by gold, then backed by trust, then supported by oil, and now increasingly tested by debt, money printing, geopolitical fragmentation, and alternative settlement systems. It means understanding that oil is not just a commodity. Oil is part of the monetary architecture. It means understanding that gold is not just a shiny metal. Gold is a signal of distrust in paper promises. It means understanding that the UAE leaving OPEC is not just a Middle East energy story. It is one more sign that the old order is loosening. And it means understanding that the opportunity is not in panic. The opportunity is in positioning intelligently before the change becomes obvious to everyone. The dollar is not going away tomorrow. But the world that made the dollar unquestioned is already changing. If you understand that early, you have options. If you ignore it, you may still have dollars. But the real question is what those dollars will buy.